Welcome to FxPro's Monday Market Roundup. As we kickstart another trading week, let's recap the significant market events from the past 7 days and spotlight the key areas to watch out for in the week ahead. Let's rewind to the latter part of last week, which was bursting with key economic data that might just give us a hint of where things are heading. Let's talk about inflation. It's been a major player in the European financial scene. And guess what? The recent figures are topping those average market predictions. Over in Germany, consumer prices in August saw a rise of about 6.1% compared to last year. And in Spain, prices climbed by 2.6% year-on-year, a noticeable uptick from July's 2.3% and June's 1.9%. Now, when we look at the entire euro area, the growth clocks in at 5.3%. And here's the twist. Many were actually expecting it to slow down to 5.1%. Typically, this kind of news would boost the currency, but the current rapid economic deceleration has put a spanner in the works. Speaking of economic shifts, German retail sales dropped by 0.8% in July, and we're seeing a dip in both consumer and business confidence. Add to that, unemployment has been on the rise for the past 7 months, peaking in August. All this combined has halted the euro's upward movement, driving euro against US dollar down to about 1.0830. But there's a silver lining. The pair seems to have found some support around its 200-day average and is trying to maintain the upward momentum that started late last year. So what's next? Expect a fierce battle for this trend in the upcoming week. The outcome could shape the market direction for the foreseeable future. Stay tuned. Alright, let's shift gears and focus on what had traders and economists glued to their screens last week, the August US jobs report. Here's the breakdown. We saw a job growth of 187K, which is above the anticipated 170K. Yet, when we peek back at July, they trimmed 30K from those figures. So, we're essentially breaking even. Now here's something intriguing. The unemployment rate nudged up from 3.5% to 3.8%. But hold on, this is not due to job cuts. More people are stepping back into the job market, likely reacting to inflation trends and long-term credit records. Wage growth? It slowed a touch, going from 4.4% to 4.3%. Might seem minor, but it did fall short of what experts predicted. This slight dip could give the Fed some pause before considering a rate hike in November. And let's be real, not many are banking on the hike this September 20th. So what's the market's take? It seems they're feeling optimistic, betting the Fed might hit pause on rate hikes. But remember, sometimes in the financial world, what seems like bad news can turn the tide. It's risky though. Hoping for a softer Fed approach means the economy might be on shaky ground. As we see this unfold with market sell-offs and a robust dollar. Alright, so here's the million-dollar question everyone's asking about the stock market. Has the August hiccup come to a close? If we're going by the vibes from Nasdaq 100 and the S&P 500, it's leaning towards a calm and collected yes. Both these big indices have hopped back over their 50-day averages and seem to be holding their high ground. And mind you, they're doing this even with some stormy economic forecasts lurking. So for those knee-deep in the equities, it's starting to feel like the storm clouds are passing. Alright, let's talk oil. It seems like oil is prepping for a major leap upwards. Just last week, US commercial oil stockpiles took a deep dive. We're talking about a 10.6 million barrel drop. And in the last 5 weeks, a whopping decrease of nearly 34 million barrels. Now these stocks are just a mere 1.1% up compared to the same time last year. And remember, this is even after releasing a big chunk, over 100 million barrels, from the US Strategic Petroleum Reserve during this time. Flashback to a couple of weeks ago, and buyers jumped back into oil right after its price dipped just below $78. For those of you into your charts and figures, that's the 61.8%. Fibonacci retracement from its run starting in June, from lows of $67, peaking in August at $84. Now this little reset wiped clean any medium-term overload, with our trusty RSI on daily charts bouncing back past the 70 mark. And here's the cherry on top. This bullish twist came right around the time of a golden cross formation. That's when the 50-day average swoops below the 200-day one. And let me tell you, that shakes the market mood in a big way. The US markets are taking a break on Monday, so no major buzz with the Labor Day holiday in play. However, the coming week has some action lined up. First up, all eyes will be on the Reserve Bank of Australia come Tuesday. While the word around town is that they'll keep their interest rate steady, possibly hinting at a hike in October, remember, the RBA's been known to throw a curveball now and then. The Aussie dollar has been doing a bit of a dance recently, bouncing from some pretty low points. So let's see if it's prepping for a comeback or just catching its breath. Midweek, we swing over to Canada. Rate decision day is Wednesday, and the consensus is probably no changes here either. But here's the takeaway: Australia and Canada are just setting the stage. Brace yourselves for a series of central bank decisions throughout this month. It's going to be an interesting one. Catch you next time, and stay sharp, traders.